Lesson 9. Fundamental Analysis in Forex. When a forecast is made of the future price movement based on the overall state of economy and taking into account various factors such as interest rates, employment, housing, production, and manufacturing, this is known as fundamental analysis. Fundamental analysts believe that the market may misprice currency in the short run, but that eventually the correct price will be reached. They may set out to profit by purchasing a mispriced currency and then wait for the market to recognize its mistake, at which point they reprice the currency. In theory, if a country's future economic outlook is good, its currency should get stronger. So, why is that? If a country's economy is improving, there may be a need to raise interest rates, control growth and inflation. Higher interest rates can attract foreign investors looking to buy the country's financial assets. In order to do that, they first need to purchase this country's currency, and higher demand means higher prices, so the value of this currency increases. Let's take a look at this very recent example. In August of 2013, the exchange rate for pound to dollar was around 1.53. The Bank of England indicated that because of the unsustainable inflation levels, it might need to increase interest rates in 2015. Only 8 months later, the exchange rate had rocketed to 1.96, a head-spinning increase of 1,600 pips.